There is a certain mystique surrounding the figure of the day trader. He's often imagined as a lone operator, a master of intuition and nerve, making split-second decisions that lead to vast fortunes. It is a world shrouded in secrecy, far removed from the patient, deliberate analysis of the long-term investor. But what if we could pull back the curtain and enter the mind of one of the original masters of this craft? What if we could learn the secrets of day trading not from modern gurus, but from a man who perfected the art over a century ago, reading the market's every move from a simple strip of paper? In 1919, Richard Wyckoff did just that. He published a small but immensely powerful book originally titled My Secrets of Day Trading in Stocks. It was not a get-rich-quick scheme, but a rare, unfiltered look into the mind and methods of a master tape reader. This video is a comprehensive summary and commentary on that work. We will dissect Wyckoff's secrets, chapter by chapter, translating his timeless wisdom for the modern trader, and revealing the profound principles that govern success in the fast-paced world of active trading. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The very first lesson Wyckoff imparts in his book is not a clever trading tactic or a secret chart pattern. It is a stern and sobering examination of the individual himself. Before one can even think about reading the tape, one must first determine if he is fundamentally suited for this demanding line of work. Wyckoff was clear. Day trading is not for everyone. In fact, he believed it was suitable for only a very small fraction of those who attempted it. He laid out a series of stringent mental and psychological qualifications that he considered to be absolutely essential for success. The first and most important of these qualities is patience. This may seem counterintuitive for a discipline known for its speed, but Wyckoff placed it above all else. The day trader's patience is not the passive waiting of a long-term investor. It is the coiled, alert patience of a predator. He must have the discipline to sit perfectly still, sometimes for hours, watching the flow of the tape and waiting for the one precise moment when the odds are overwhelmingly in his favor. The amateur is constantly seeking action. He feels he must be trading to be making money. The professional, Wyckoff taught, understands that his profits are made not in the trading but in the waiting. He acts only when the market presents a clear, high-probability opportunity. To act at any other time is to gamble, and a day trader cannot afford to be a gambler. The second essential quality is courage. This is not the reckless courage of a gambler who bets everything on a single turn of the cards. It is a cold, calculated courage. It is the courage to act decisively and without hesitation when your moment arrives. It is the courage to pull the trigger on a trade when your analysis confirms the opportunity, even if it goes against the prevailing market sentiment. But even more importantly, it is the courage to take a small loss immediately and without question, the moment the tape tells you that your judgment was wrong. The amateur is afraid to take a loss. He holds on, hoping the trade will come back. The professional knows that his first loss is his best loss. He has the courage to admit his mistake instantly, preserving his capital and his mental clarity for the next opportunity. The third quality is supreme concentration. The tape reader in Wyckoff's day was watching a continuous stream of prices and volume printed on a thin strip of paper. He had to be able to focus with unwavering intensity, shutting out all distractions. His mind had to be completely absorbed in the flow of the market, interpreting the meaning of every transaction. Any lapse in concentration could mean missing a critical signal. This requirement is no different today. The modern trader, with his multiple screens, news feeds, and flashing indicators, faces an even greater challenge to his concentration. He must be able to filter out the noise and focus solely on the most important information, the price and volume action. He must, as Wyckoff did, become one with the flow of the tape. Finally, Wyckoff demanded absolute self-control. The day trader is constantly exposed to the two most powerful emotions in finance, greed and fear. He must be the master of these emotions, not their servant. He must have the self-control to stick to his plan, to follow his rules, and to never let a profitable trade turn into a rush of ego or a losing trade descend into a spiral of hope and fear. He must remain a cold, detached, and objective observer of the market's action, acting only on the basis of sound, logical deduction. Wyckoff believed that a calm, well-balanced disposition was a prerequisite for this work. A man who is easily excited, easily discouraged, or prone to anxiety has no place in the day trader's chair. Wyckoff was also unflinchingly honest about the immense physical and mental strain involved in this work. He described true tape reading as the most exhausting of all professions. It requires a level of concentration that few people can sustain for long periods. The constant pressure of making rapid decisions, managing risk, and maintaining emotional control takes a tremendous toll. He advised that no one should attempt this work unless they are in excellent physical health and have a strong, resilient nervous system. He saw it not as an easy path to wealth, but as a demanding profession for a select few who possessed the rare combination of mental fortitude and emotional discipline required to master it. Having laid out the formidable personal qualifications, Wyckoff then turned to the practical tools of the trade. While the technology has changed dramatically since 1919, the principles behind the tools he described remain perfectly relevant today. His entire world revolved around one key piece of equipment: the stock ticker tape. This was a simple machine that printed a continuous stream of information on a thin strip of paper. A stock symbol, the price of the last trade, and the number of shares traded. This was the pulse of the market, and to Wyckoff, it was the only source of information that mattered. The modern equivalent of the ticker tape is the combination of the time and sales window and the level 2 quote screen. The time and sales window is a direct, real-time feed of every single trade that occurs, showing the price, the volume, and the time of the transaction. It is the modern tape. The level 2 screen shows the current bid and ask prices, along with the number of shares being offered at each level. It is a view into the order book, showing the immediate supply and demand for a stock. A modern Wyckoff analyst learns to read these two windows with the same intensity that Wyckoff read his paper tape. He watches the size of the trades, the speed at which they are executing, and the way the bids and asks respond to the pressure. This is the modern art of tape reading. Wyckoff also stressed the importance of the broker. In his day, this meant having a broker who was physically close to the exchange floor, ensuring the fastest possible execution of his orders. Today, this translates to choosing a brokerage platform that offers high-speed, direct access execution and a stable, reliable data feed. The principles are the same. The day trader needs to be as close to the market's action as possible, with the ability to enter and exit positions with instantaneous precision. The choice of tools and a broker, Wyckoff argued, was not a minor detail. It was a critical component of a professional trading operation. Having established the formidable personal qualifications and the necessary tools for a day trader, we now transition from the foundation to the core skill itself. A trader can have the strongest nerves, the best equipment, and the quickest broker on the street, but without the ability to correctly interpret the market's action, he's merely a well-equipped gambler. The heart of Richard Wyckoff's entire method, the skill upon which his legendary success was built, was the art and science of deduction from the tape. This section is a deep dive into that core skill. We will explore how Wyckoff viewed the ticker tape not as a random stream of numbers, but as a moving picture, a continuous narrative of the battle between supply and demand, and how he read that narrative to anticipate the market's next move with uncanny accuracy. Wyckoff's most powerful metaphor for his craft was that of the tape as a moving picture. He urged his students to see the flow of transactions not as isolated events, but as a continuous story unfolding right before their eyes. Each print on the tape was a single frame in this motion picture. The plot of this story was the constant struggle between the forces of supply and demand. The characters were the buyers and the sellers, and the astute tape reader was the audience member who, by closely following the plot and understanding the character's motivations, could anticipate the next scene before it happened. This required a profound shift in perception. The amateur sees only the price. He is excited when it goes up and fearful when it goes down. The professional Wyckoff analyst sees the story behind the price. He is less concerned with the price of any single transaction and far more interested in the character of the trading. How is the stock acting? Is it strong or weak? Is it advancing with ease or is it struggling? Is it declining reluctantly or is it falling under heavy pressure? The answers to these questions are all contained in the flow of the tape. The tape reader's job is to become so immersed in this moving picture that he develops a feel, an intuitive sense, for the market's immediate trend and its probable future course. The fundamental language of this story is that of supply and demand. Every transaction on the tape represents a meeting of these two forces. A share is bought and a share is sold. The price at which they meet is the point of temporary equilibrium. The tape reader's entire purpose is to gauge the relative strength of these two forces as they wage their continuous battle. He does this by observing several key factors. First is the price level of the trades. Are successive trades occurring at the same price, at a higher price, or at a lower price? A series of trades at progressively higher prices, such as 50, then 50 and 1/8, then 50 and 1/4, is a clear indication that demand is aggressive and is overpowering supply. Conversely, a series of trades at progressively lower prices shows that supply is dominant. Second is the volume of the individual trades. A trade of 100 shares has a different meaning than a trade of 5,000 shares. The volume tells the analyst the intensity of the supply or demand. Third is the activity or the speed of the tape. A dull, slow tape with long pauses between trades indicates a lack of interest from both sides. A sudden burst of activity with trades printing in a rapid-fire succession shows a sudden and urgent influx of either buying or selling. This change in tempo is often the first sign that a significant move is about to begin. By combining these observations, the analyst can determine the quality of the supply and demand. Is the buying aggressive, where buyers are reaching up and taking stock at the offered price? Or is it passive, where they are simply placing bids and waiting for sellers to come to them? Is the selling panicked and forced, where sellers are dumping their stock at the bid price? Or is it deliberate and controlled, where large blocks are being offered at a fixed price, capping any rally? The ability to answer these questions by observing the flow of transactions is the essence of reading supply and demand from the tape. The most critical secret to unlocking this language, Wyckoff taught, was the ability to distinguish between the actions of the composite man and the actions of the public. This is done by analyzing the size of the trades, or the large lots versus the small lots. The tape tells you not only the price, but how many shares were traded. This information is the key to identifying the players. Large lots, trades of 1,000, 5,000, or even 10,000 shares are almost always the work of the composite man. The average trader does not operate in such sizes. Therefore, the appearance of these large blocks on the tape provides a direct window into the actions of smart money. Their interpretation depends on the context. If a stock is in a decline and a large block is bought at the bid price, absorbing a wave of smaller sell orders, it is a clear sign of support and potential accumulation. If a stock is in a rally and a large block is offered for sale, capping the advance and absorbing all the small buy orders, it is a sign of resistance and potential distribution. Small lots, trades of 100 or 200 shares, are typically representative of the actions of the public and smaller floor traders. While a single small trade is insignificant, the collective action of thousands of these traders creates the broad market into which the composite man operates. The behavior of these small lots reveals the sentiment of the crowd. A flurry of small buy orders at rising prices near the top of a move shows public excitement and euphoria. A cascade of small sell orders at declining prices near the bottom of a move shows public panic and capitulation. The genius of Wyckoff's method lies in observing the interplay between these two forces. For example, if a stock is rallying and the tape shows a continuous stream of small 100 share buy orders, but every time the price ticks up a fraction, a large 5,000 share sell order appears and stops the rally cold. The analyst is witnessing distribution in real time. The composite man is using the public's enthusiastic buying to unload his large line of stock. Conversely, if a stock is declining and the tape is filled with small, panicked sell orders, but every time the price dips to a certain level, a large 10,000 share buy order appears and absorbs all the selling. The analyst is seeing accumulation. The composite man is using the public's fear to acquire his inventory. With the ability to read the tape, the analyst can begin to apply this skill to the practical work of market technique. This involves identifying key technical levels and understanding the broader psychology of volume. The tape itself can be used to identify points of support and resistance long before they become obvious on a chart. Support is a price zone where buying is sufficient to overcome selling pressure and halt a decline. On the tape, this is seen as a level where declines are repeatedly stopped, where large buy orders appear to absorb the selling, and where the volume of selling begins to dry up. Resistance is the opposite. It is a price zone where selling pressure is sufficient to overcome buying pressure and halt a rally. On the tape, this is seen as a level where advances are repeatedly capped, where large sell orders appear, and where the volume of buying begins to diminish. This tape reading skill is the microscopic application of the broader psychology of volume, which is Wyckoff's third fundamental law, effort versus result. The volume of shares printed on the tape is the effort. The price movement that follows is the result. A surge of volume on the tape that fails to move the price is a critical sign of a turning point. It shows that a massive effort is being met by an equally massive counterforce. This real-time analysis of effort and result is what gave Wyckoff his incredible ability to forecast the market's immediate next move. Wyckoff's method of deducing future market moves from the past and present action of the tape was his primary method of forecasting. He was one of the titans of his era in this field. It is worth noting that another legendary figure of the same period, William Gann, developed his own unique and profoundly different methods for forecasting market turns, while Wyckoff focused on the internal market dynamics of supply and demand. Gann incorporated the study of geometry, natural law, and time cycles to project future market movements with astonishing accuracy. For those who are fascinated by the science of market forecasting and wish to explore these complementary yet distinct approaches, you are invited to visit our new sister channel, William Gann Trading Insights, for a deep dive into his remarkable methodologies. Having mastered the foundational skill of reading the ticker tape, deciphering the continuous story of supply and demand in real time, we now transition from pure analysis to strategic application. It is one thing to understand the market's language. It is another to act upon it with the precision and confidence of a professional. This section is dedicated to Richard Wyckoff's advanced tactics. We will explore how he translated the deductions from the tape into concrete trading campaigns. We will delve into his contrarian approach to dull markets, his philosophy on the proper use of charts, and his specific rules for managing a trade from entry to exit. This is where the art of tape reading is forged into the business of profitable trading. One of Wyckoff's most profound and counterintuitive secrets concerned the very markets that most traders despise. This was his insight into dull markets and their opportunities. The average trader craves action. He is drawn to volatile, fast-moving stocks that offer the promise of quick profits. A dull, inactive market where the price barely moves for days or weeks on end is, to him, a wasteland devoid of opportunity. He quickly loses interest and moves on to find more exciting prospects. Wyckoff, however, understood that this was a critical error in judgment. He taught that it is precisely in these periods of extreme dullness that the most significant and profitable opportunities are often born. The philosophy behind this principle is rooted in the actions of the composite man. A dull market is a sign that the public has lost interest. The gamblers and the impatient traders have gone elsewhere. This creates the perfect environment for a large operator to conduct a campaign of accumulation without attracting unwanted attention. He can quietly absorb the small lots of stock that come for sale from discouraged or indifferent holders without bidding the price up against himself. A prolonged period of dullness, especially after a long decline, is often the clearest sign that the floating supply of a stock is being methodically absorbed by strong hands. The tape reader sees this dullness as a powerful signal. The long pauses between trades, the narrow price fluctuations, and the extremely light volume are all evidence that the selling pressure has been exhausted. It is the quiet before the storm. The practical application for the Wyckoff analyst is to pay the most attention when the market is the least interesting. He must cultivate the patience to watch a stock during these periods of hibernation, waiting for the first signs of life. The first indication that the accumulation is complete and the markup is about to begin. The first surge of volume and activity after a long, dull period is one of the most reliable signals that a major move is imminent. While Wyckoff was a master tape reader, he was not opposed to using charts. His 6th chapter deals with the proper use of charts. However, his philosophy on their use was radically different from that of many modern technical analysts. For Wyckoff, charts were aids, not masters. He was deeply critical of the practice of mechanically trading based on chart patterns alone. He viewed the markets as a deeply psychological arena, not a machine that could be decoded with a simple set of geometric shapes. He believed that a trader who relied solely on patterns, without understanding the underlying forces of supply and demand that created them, was destined to fail. The primary function of a chart, in Wyckoff's view, was as a tool for recording market action and clarifying the overall picture. A chart is a condensed history of the battle between buyers and sellers. It allows the analyst to see the broad structure of the market, the trading ranges, the trends, and the major turning points far more clearly than he could by relying on memory alone. The chart provides the context. It is the map of the campaign. The most effective approach, Wyckoff taught, was the combination of chart analysis and tape reading. The chart gives you the long-range perspective, while the tape gives you the close-up, moment-to-moment details. The analyst would first use his charts, primarily vertical bar charts and point and figure charts, to identify a stock that appeared to be in a phase of accumulation or distribution. He would use the chart to understand the big picture, where the support and resistance levels were, where the major buying and selling had occurred, and what the probable next major move was likely to be. Once the chart had given him the strategic overview, he would then turn to the tape for the tactical execution. He would watch the tape intently to determine the precise moment of least resistance to enter the trade. He would wait for the tape to confirm the chart's story. For example, if his chart indicated a stock was in accumulation and nearing a breakout point, he would watch the tape for a surge in volume on the bid side, for large lots being taken at the offer, and for a general drying up of selling pressure. This combination of the broad view from the chart and the immediate real-time evidence from the tape created a powerful, synergistic approach that provided a far higher degree of accuracy than using either tool alone. With a position initiated, the final and most critical part of the process begins: managing the trade. Wyckoff's 7th chapter provides clear, logical rules for this crucial phase. The first rule is the correct placement of the stop loss for active trading. A day trader, by definition, is operating on small fluctuations and cannot afford to risk several points on a trade. His stops must be close, but they must also be logical. Wyckoff taught that the best place to set a stop is at a point of resistance. This means placing the stop just on the other side of a level where the tape has shown that a significant opposing force exists. For a long position, this might be just below a price level where a large buy order previously appeared on the tape and halted a reaction. The logic is that if this support is violated, the technical picture has changed, and the trade is likely wrong. For a short position, the stop would be placed just above a level where a large block of stock was previously offered, capping a rally. This method of placing stops based on the immediate, observable evidence of the tape allows the trader to operate with a very small and clearly defined risk on every single trade. The second rule of trade management is the offensive principle. Let your profits run. This is the tape reader's version of the core Wyckoff rule. The amateur is always tempted to snatch a small, quick profit. The professional knows that the big money is made by riding a winning position for as long as the trend is valid. The tape reader determines this by constantly assessing the character of the market's action. He holds his long position as long as the tape continues to show signs of strength. Rallies on expanding volume, reactions on light volume, and a general lack of significant selling pressure. The moment the tape shows a change of character, for example, a rally that stalls on huge volume, effort without result, or a sharp decline on heavy volume, he is alerted to the probability that the trend is ending. He does not wait for a chart to confirm this. The tape gives him the earliest possible warning. This allows him to exit his position with the maximum possible profit, just as the smart money is beginning to distribute its shares. This constant process of judging the market by its own action is what allows the professional tape reader to navigate the short-term swings with both safety and profitability. Having journeyed through the demanding personal qualifications, the essential tools, the core skill of tape reading, and the advanced tactics of a master day trader, we now arrive at the final and most profound part of our study. We move from the specific techniques of trading to the overarching philosophy that ensures not just temporary success, but a long and prosperous career in the financial markets. The final chapters of Richard Wyckoff's book are dedicated to the principles that govern the trader's mind and his long-term financial strategy. These are not mere tips. They are the final distilled secrets from a lifetime of experience. This is the wisdom that transforms a skilled tape reader into a true market professional. The 8th section of our analysis combines Wyckoff's concluding chapters into a series of powerful final instructions and core philosophies. These are the principles that a trader must internalize until they become second nature. The first and most important of these is the principle of intellectual independence. Wyckoff was adamant that a trader must learn to think for himself. In his era, just as in ours, the financial world was filled with the noise of tips, rumors, and the confident predictions of so-called experts. The public, always seeking a shortcut, eagerly consumed this information, hoping to be told what to do. Wyckoff saw this as a certain path to ruin. He taught that any information that comes from an outside source is, by its very nature, second-hand, and likely too late to be of any real value. The true professional does not rely on the opinions of others. He relies on his own ability to read the tape. The tape, he argued, contains all the information that matters. It reflects the actions of the insiders and the large operators long before their plans become public knowledge. To rely on anything else is to be perpetually one step behind the smart money. The practical application of this principle is to cultivate a mindset of healthy skepticism. You must learn to do your own work, to form your own judgments based on the evidence of price and volume, and to have the courage to act on those judgments, even if they contradict the prevailing sentiment of the crowd. The second final secret is the mastery of emotional control. Throughout his book, Wyckoff returns again and again to this central theme. The day trader operates in an environment of intense psychological pressure. He is in a constant battle with the two most powerful and destructive human emotions, hope and fear. The amateur is a slave to these emotions. He holds on to a losing trade out of the desperate hope that it will come back. He snatches a small profit out of the fear that it will disappear. These two impulses, Wyckoff argued, are the primary cause of failure. The professional trader must be a master of his own mind. He must cultivate a state of perfect calm and emotional detachment. His actions must be guided not by emotion, but by cold, hard, logical deduction. When the tape tells him he is wrong, he accepts the verdict immediately and takes his small loss without hesitation or regret. He has eliminated hope from his trading equation. When the tape tells him he is right, he has the patience and self-control to hold his position, allowing the profit to run for as long as the evidence of strength remains. He has conquered fear. This emotional discipline is not a natural talent. It is a skill that is forged through conscious effort, rigorous self-analysis, and years of experience. The third final secret is the commitment to continuous learning. Wyckoff viewed the stock market not as a game that could be solved, but as a subject of lifelong study. He himself, even after decades of success, remained a tireless student of the market. He was constantly observing, analyzing, and refining his methods. He knew that the market was a dynamic, ever-evolving entity, and that the operator who stopped learning was destined to be left behind. The market is the ultimate teacher, and it is a harsh one. It provides the lesson first, and the explanation later. The professional trader embraces this process. He studies his losses with the intensity of a scientist, seeking to understand the reason for every mistake. He reads, he observes, and he constantly strives to improve his judgment and his technique. He understands that his education is never complete. This brings us to one of Wyckoff's most important, yet often overlooked, philosophical concepts, the connection of day trading to the bigger picture. For Wyckoff, active trading was not an end in itself. He did not view it as a get-rich-quick scheme or a form of high-stakes gambling. He saw it as a business, a profession, and most importantly, as a powerful engine for generating capital. But what was the purpose of that capital? Wyckoff's ultimate goal was not to remain a day trader forever, but to use the profits from his active trading to build a foundation of long-term, secure wealth. He was, at his core, a conservative and prudent businessman. He practiced what he preached, using the income generated from his tape-reading operations to purchase sound, high-quality stocks and bonds for long-term investment. He was, in essence, a trader in order to become a better and more substantial investor. He used the high-risk, high-skill endeavor of tape reading to generate the funds that he could then deploy into lower-risk, long-term assets that would provide a steady income and appreciate over time. This is a profound and powerful model for financial success. It separates the act of income generation from the act of wealth preservation and growth. This is the perfect moment to discuss a crucial synergy between Wyckoff's two greatest works. We have just spent this entire video dissecting the secrets of his book on active trading, a masterclass on the engine for generating income. But what did Wyckoff do with that income? His other masterpiece, How I Trade and Invest in Stocks and Bonds, is the answer. That book is his definitive plan for converting trading profits into lasting, long-term capital. Our new adapted edition of this book is the indispensable companion to the secrets we have discussed today. The first book teaches you how to earn an income from the market. The second teaches you how to preserve and multiply that income to build true wealth. The link to this essential complementary guide is in the description below. In conclusion, the secrets of Richard Wyckoff's Day Trading Bible are not the clever tricks or complex formulas that many seek. They are a set of profound and timeless principles that define the character and the methodology of a true market professional. Success in this demanding field, he taught, is not a matter of speed, excitement, or luck. It is the result of unwavering discipline, of patient, logical deduction, and of the cold, unemotional work of a master craftsman. It requires the courage to act decisively, the humility to admit mistakes instantly, and the patience to wait for the perfect opportunity. The trader who internalizes these lessons, who learns to read the tape, to control his emotions, and to treat his craft as a serious business, is the one who will not only survive but thrive.